Okay, tax students, this is the second video for chapter 3 where we're learning business expenses, business deductions. So here is the next one called educational expenses. Now keep in mind that back in the previous semester for Accounting 134, you had probably learned about tax credits, and one of the specific ones we had learned was called the American Opportunities Tax Credits or the Lifetime Learning Credit. So whatever costs you use for these credits, you cannot use them again as a deduction here for your business. It's either one or the other. Now, if you do qualify for the American Opportunities Credit, probably that's going to be better than claiming a business deduction. And if you don't qualify for the American Opportunities Credit, then probably claiming that educational cost, if it qualifies as a deduction here for your business, is going to give you a better benefit than the the Lifetime Learning Credit. Of course, the reason why is that you get to reduce your federal income tax and your state income tax and that self-employment tax that we had learned earlier in this chapter. Whenever you claim a business expense, you can probably reduce all of these three taxes. But you should try to work out the numbers if you qualify for American Opportunities and or claiming it as a deduction here we're learning in chapter 3 and see which one gives you the better tax result. Also keep in mind that what we're learning here in chapter 3 is when a taxpayer has their own business and not treated as an employee. If you have expenses as an employee, they're no longer deductible since 2018 through 2025 or 26. Under the old rule back in 2017, employees could claim business expenses as itemized deductions. Again, we learned that topic last semester, but no longer from 2018 through 2025-06. So some of the rules being applied here in this chapter 3 kind of gives you the impression possibly employees can take deductions. That's not true. You got to have your own business. Now, here in the case of educational expenses, there's possibly two situations where you can claim education as an expense. For this first one mentioned here, it says that the taxpayer is already grandfathered in at a certain position or certain job title. That's probably true for an employee. Yeah, so again, this no longer applies. So possibly what we should be looking for, at least for the next few years, is when the education expenses for a business person is going to be incurred to maintain or improve existing skills to do the job they already are doing. Okay, they already have to be in the profession, and now they need more education to do a better job. So the opposite situation is, let's say maybe you're an accounting major going to school, paying tuition, buying textbooks to learn accounting. But right now you're not working as an accountant or bookkeeper or in the accounting field because it's going to be leading to a new profession. The current educational cost is not deductible. But let's say you already are doing bookkeeping work. You already are preparing tax returns and you want to improve your skills. Now, in this case, you have a good cause to claim your educational costs as a deduction. But again, it has to be as for your own business and not an employee. Okay, so improving, maintaining skills for a job or career you already are in and not leading to a new one. Okay, so that's education. Let's move on to the next topic. If your educational cost is deductible, then any transportation or travel costs related to that education should also be deductible. So this is a little more clear cut. If you have dues licenses, subscriptions, publications related to your career, your business, then that type of cost should be deductible. So if you're in a profession like accounting, you probably, or a CPA, you're going to join the American Institute of CPAs and pay annual dues. Those are deductible. Here in Hawaii, the local association is called the Hawaii Society of CPAs. Yeah, I remember every summer I have to pay these dues and I deduct them on my Schedule C. Again, if you're an employee paying these dues, not deductible. So if you work for an employer, you probably want them to pick up the costs and reimburse you for your fees. Now, the limitation for all the rules we're learning here in Chapter 3 would apply to them and not you. You're in a neutral position. You paid the cost and got reimbursed, so you end up with zero. Now, it's the employer who has their own business are subject to these rules we're learning here to be able to deduct business costs. Uniforms. Generally, the general rule is this number 2 here. Can be deductible if it's not suitable for everyday wear. So let's say you have your own contracting business and you wear jeans and a t-shirt to work every day. Because you can wear jeans and t-shirts anywhere, the cost of those type of clothing are non-deductible. So typically, if you have an employer that makes you require you to wear a uniform, they're going to have stuff like a logo. They're going to make it so that it's not usable for typical wear outside of your job. And then that usually makes it deductible. Now, if you have other types of stuff you wear, like safety shoes, hard hat, stuff that is really part of your working environment, then that should be deductible. But again, it has to be business sole proprietorship related and not as an employee. So again, if you work for someone else, you want them to reimburse you, and now they can probably deduct that cost as a sole proprietor or as a corporation or partnership. So we want to promote good relationships with our customers, with our patients, with our clients. And we do that by maybe giving them gifts, but there's a dollar cap of $25 per recipient during the year. And if the client is a couple here, then this $25 limit would be the total for both of them, not $50. Small gifts like stuff with your logo, just a reminder that, they can call you for services like calendars and pens that cost under $4 each. There's no limit to that, but each item has to be under $4. Of course, if you start giving stuff to family and friends, that's not really business related and that should not be deducted. Okay, that's business gifts. Oh, and under this same section, I believe they also talk about awards that you probably give to employees. And if the amount is not money, but some type of what they call tangible property, and it's worth less than $400, then you can claim that as a deduction. It still may be taxable to that employee, but now you also can claim it as a deduction. Here it says if this awarding program, usually it's based upon, here they call length of service or job safety. And if it's a qualified plan, plan means that you don't discriminate typically to higher paid employees, then that $400 limit goes up to $1,600. Again, it can cause this to be treated as a wage or salary income to the recipient, yeah? But it's also now a deduction to your business. And of course, we know we have to have good records, keeping receipts, knowing the dollar amount, knowing the date, time, and place, knowing how it's related to business, who's the customer here that you're dealing with. So, in addition to receipts, again, a good calendar is something that's useful to document all of this. Bad debt expense is possibly a topic that you had learned in a financial accounting or bookkeeping class. So the way I want to approach this is through something called journalizing. So if you remember back in that previous accounting class, you learned that you record transactions using something called debit and credits to increase or decrease dollar amounts in accounts. So let's say that you make a sale to a customer and you collect the money at the same time. So to record the money, you record a debit to the money account, the cash account. And then the reason why you got the money is the credit. So here's the income. Here's the revenue called sales. Okay, and then you already got your money and you're not waiting to collect it. So there cannot be any bad debt. Bad debt is when you are owed money and you cannot collect it. Or here you already got the money. So you're not waiting for it. But let's say this didn't happen. You didn't collect the money. Instead, now you still report the income, credit sales, but the thing you debit now is the right to collect the money called accounts receivable. So now you're waiting to collect the money and you're waiting to collect the money. And if you cannot collect the money, now you have a bad debt. In this first case where you did collect the money, there's no such thing as bad debt. If you use what they call the cash method of accounting versus the accrual method of accounting, which you again probably learned in a previous financial accounting class. Cash method, there's no such thing as bad debt expense. There are bad debts, but you cannot deduct it if you did this here. And if you never recorded the cash being collected, cash basis, then there is no bad debt because you didn't record the revenue and pay taxes on that. But if you are accrue basis, here's what you did. Accounts receivable, money owed to you, and you paid taxes on this revenue. But then later on, you cannot collect the money. Let's say you have lots of people who owe you money, but for tax purposes, you got to identify the specific customer and the specific dollar amount you cannot collect. Then what we're going to do is called write-off. You're going to take away this receivable, not by scratching it off, but doing just the opposite. You're going to credit that receivable to offset the debit to the receivable. But at the same time, you got to record something else here being debited. And that's this account right here. The bad debt expense being deducted now on your tax return, reducing your profit. Again, you cannot have a bad debt expense unless you recorded the receivable and the revenue in the first place. You have to be using what they call the accrue method. If you're using the cash method of accounting, you never had reported the sale. Thus, you're never going to have a bad debt expense. Okay? Customer still owes you money, but there's no expense for cash basis method of accounting taxpayers. I know that's a little bit confusing if you had taken that previous financial accounting class because you learned to do, again, what they call the accrue method accounting. Okay, let's move on to our next topic, which is, we just did this now, business bad debt. Yeah, offsetting business income in your Schedule C, sole proprietorship. Now let's talk about non-business bad debt. You as a taxpayer are not in the business of lending money. If you were, then you would be a bank or you'd be selling merchandise on account and you could deduct business bad debt expense like in the previous screen. But if you're not in the business of extending credit, not in the business of lending money, but you lend out money anyway and you cannot collect it, Now, maybe you have a non-business bad debt to deduct now. So the typical situation is you lend money, not in your business now, but let's say you're lending it to a friend or a family member and you cannot collect it. Okay, now you have a non-business bad debt. Non-business bad debts are treated as short-term capital losses. So in the previous semester in Accounting 134, you learned that capital losses can offset capital gains. And then any excess capital losses up to 3,000 per year can be used to offset other income, other ordinary income like business income. But capital losses have this limitation to only offset capital gains and then another 3,000 to offset other income. Any unused capital losses at that point are carried forward to next year to offset next year's capital gains or another 3,000 of ordinary income. Now, to be able to document a non-business bad debt, you got to treat it very formally. You got to make sure you have a promissory note signed by whoever you lent the money to. You got to make sure you're charging a market rate interest percentage. You got to make sure you set a deadline, a term to collect the money. You got to put in the effort to collect money, which is kind of hard, yeah, to make a family or a member or friend do. That's why it's not good in the first place to lend money to them. But only then, after trying to do all of this, you cannot collect the money. Only then you have a non-business bad debt deduction. Again, limited to the calculations mentioned here. Okay, next category, deducting expenses related to a home office. Okay, you're working at home. And there's possibly 4 different situations here where you're allowed to claim a home office deduction. So let's kind of take a look at these different 4. So the first one here mentioned is where the main place of your business is your home. Okay, they call that principal. A lot of us may have a office someplace else and do work also at home. That someplace else is your principal place. But if you don't have a principal place, that means your home is the center of your business. Now, not the whole home is going to be used right for business. Maybe just one room. But that one room or that space has to be used regularly for your business and has to be used only for your business. This is the hard one here, exclusive business use. So if you use your bedroom to sleep and to dress and to do your business, that's not exclusive. So typically what you do is you make one bedroom your den only used for business. You use it regularly throughout the whole year. This is the only place maybe you do have your place of business. Only then you can claim a home office deduction. A second situation mentioned here is if you meet patients, clients, customers regularly at your home office. And again, it has to be exclusive, but this time it doesn't have to be your primary place. Maybe you have another business office and you do some meeting with your customers here. But that space at home has to be only used for business. So now again, part of that home cost can be deducted as a home office expense. Our third situation mentioned here, yeah, number 3, is if the home office is not part of the main building but a separate structure. But again, it has to be used only for business on a regular basis. Again, you can still have someplace else, another office someplace else, but if it's a separate structure, you can possibly deduct the cost of that. And then the fourth one is to use your home. Here's the fourth, to use your home for storage space. And it has to be your home has to be the only place of your business. Yeah. So typically, you can see people have a shed or a garage, and the only thing they keep in there is not their car, but the products that they sell. Yeah, and again, this home office is the only place to use for business. So these are the situations where you can claim a home office deduction. Now, calculating how much you can deduct, here we're told that the deduction for home office cannot generate a loss. Here, the business income, the net income cannot go below zero after deducting the home office deductions. Now we'll see in the form that maybe any unused home office deductions can be carried over to next year. So some of the home office costs includes if you rent, would be rent. If it's a home you own, maybe the mortgage interest, insurance, repairs, utilities, homeowners association dues. Here's something we'll learn a couple chapters from now, depreciation. So what we do is calculate the cost of all of this for the whole home. But we cannot going to deduct the whole home costs because your business doesn't occupy the whole home. What we're going to do is take a percentage of that home cost. Here, this allocation. So the best way to show you that is to use the form you have to fill out in calculating the home office deduction. So here it says to figure out the square footage of what you use for business and compare that to the total home square footage and divide one by the other to get some kind of percent we're going to be claiming. If your home is used for daycare, then there's probably some personal and business use kind of mixed up together. So there's a different calculation for that, which we're not going to assume. Then here you can see all the different types of costs mentioned before. We divide it to direct and indirect. Most of it is going to be indirect, meaning both personal and business use. The ones that are directly for business, you get to deduct the whole thing up to that limit we mentioned up here, up to the not creating a loss for the business. Okay, and you multiply these costs by the percentage to get what you can deduct. But again, you cannot go below zero for your business, creating a loss. Here at the very bottom, you can see any unused home office expenses get to be carried over to next year to this same form and subject to the same limitations. Okay, so that's home office expenses. An optional method of calculating home office expense, instead of taking a percentage and multiplying all the different costs, here it says that for every square foot of home office, you can claim a $5 amount up to a maximum of $1,500 or 300 square feet. Okay, so you can pick whichever one is better for you, and you pretty much have to, I believe, stick with that method for the following year. So with this optional safe harbor method, it makes things much simpler. Keep in mind again, what we're doing is for sole proprietors, people that have their own business. If you're trying to claim a business deduction as an employee, well, sorry, because under the Tax Cut and Job Act, all of that type of employee business expenses are no longer deductible for 2018 through 2025. Okay, last category of possible deductions or non-deductions is if your activity is considered to be a hobby, you still have to report all of the income, but if it's classified as a hobby, then none of your expenses are deductible. All income taxable, none of the expenses deductible. So here it kind of mentions stuff like breeding racehorses or possibly stuff that are craft related. You know, you make a lot of craft items and you give it away to friends and family and you sell a few, okay, because it may not be the primary uh, means of making money in your situation, a so-called hobby. None of the costs are deductible. All of the revenue is taxable. In fact, you don't even use a Schedule C if your activity is classified as a hobby. You just report the gross amount as miscellaneous income and you forget about any deductions. It's kind of harsh. So, what we try to do if it's close to being a hobby is to see if we can meet a lot of these items listed here as indications of a true business. Now, you're not going to meet them all, but as much as possible, if you can meet these items, you probably can be treated as a business. And even though there's a loss, hobby loss deduction, you can business deduction, you can deduct it. The most positive way of treating your loss as a deductible is if out of the past 5 years, three show profit. Even though 2 years are losses, you get to deduct those losses. That's kind of hard to me for a lot of startup businesses where you have continual losses, yeah? But take a look at this list of activities. And as much as possible, we try to meet them. And if you still have a loss and you meet these items, you can deduct the losses. Yeah, and offsetting other income, reducing your taxes. Okay, let's stop here. Make sure you take a look at the video covering Schedule C, a separate video for Schedule C.